You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Cobus Potgieter from Southern Cross Capital, David Shutte from Robert Group. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV. #Stockwatch. Gents, thanks for the time today. Devin, let's start with you. We had Nasdaq and S&P closing all-time highs on Friday. I hold ETFs in both, so I'm not complaining. But I got to say, I look at the valuations, and how are you thinking about US valuations with those indices at absolute records?
Yes, look, I mean, what a week where you had the S&P reaching records every day of that week. That's quite something. So, yeah, as an investor, we're cheering. If you've got the ETFs in your portfolio, well done. But, yeah, I think there is a concern over valuations. I think from a momentum perspective, ever since Liberation Day, we've just had really, really strong momentum coming into global equities, US equities, and the like. So that's been really nice, quite broad-based. But the question is for how long? And I think that, that goes to your question around valuation. My sense is that particularly with, us getting into a lot of the Mag 7 earnings this coming week, there's going to be very, very little forgiveness for disappointments on the earnings side. So I think we're going to watch that closely. Companies like Apple, Amazon, Meta, Microsoft, all out.
Yeah.
And I think, unfortunately, with the market running so hard, any misses are going to be punished.
Yeah, that's actually a good point. When it's priced for perfection, you've got to be perfect or better. Cobus, as I know, you guys are more local focused, but you must keep an eye on what's happening on the US. And part of it, wishing our market work. Mind you, we are just off highs. I suppose we can't complain. But also just in a sense of some wild valuations there.
Yes. Look, I've been actually being so locally focused. I'll point out that your local ETFs in rands have far outperformed your S&P ETFs this year to date at the very least. And on that basis alone, we've actually been of the view of, given that the rand is so strong relative to the USD and that relative underperformance offshore versus local we have experienced, we've been shifting a little bit offshore in the last couple of weeks. I agree with Devin more broadly, however, historically speaking, when the S&P clocks these historical highs, 8 out of the last 10 times, there was actually a buying indicator more than anything else.
Yeah.
I wouldn't sell momentum, and I think just more generally, given the outlook around the tariffs, the tariffs coming out less severely than the market had anticipated, and there's still a bit of runway before we actually see the real effects of those tariffs. We of course know we're leaving GDP growth globally on the table. There will be negative effects, but the market seems less concerned about that at the moment. And I think there's still some legs left in the market before we see any sort of significant catalyst that could lead to a global equity market sell-off.
Yeah, and you're totally right. I mean, we shouldn't be scared of all-time highs. They boggle the brain sometimes, but if they're going to go higher, we'll take that every time. Cobus, staying with you, we had Valterra Platinum results. This, of course, the old Anglo-Platinum American. A horror set of numbers, but there was floods back in February, significant floods, low prices. Key point, perhaps backward looking. Question I got is, should I be worried about the Valterra results? Is there still opportunity here? And maybe the key point is that results look back and things have changed since February and truthfully since June.
Yes, look, I always say the market always has difficulty, and look, I mean, all of us as the market participants have difficulty pricing businesses post these complicated restructures. We saw multiple times the likes of Boxer coming out of Pick and Pay, precisely the same thing. That first set of results, it's complicated. We're still unscrambling the egg. So that was a bit of a drag, in addition to the flooding, which, to be fair, all of this was very well guided. The only real miss in these numbers was the dividend, which came in at half of what was expected. And to some extent, this remains the highest quality platinum play locally. And if you like the thesis behind platinum, this simply looks like yet another attractive entry point into the highest quality platinum producer.
Devin, I mean, when the unbundling happened, I expected more weakness because a lot of folks would have got a counter they didn't particularly want. Of course, it coincided with a massive run in the PGM prices. Devin, how are you looking at PGMs, in particular Valterra?
Yeah, look, I think the timing was good when they unbundled, and so they've caught the upside of these PGM prices. I agree with Cobus. I think that you've got a real quality producer here. Obviously, the floods affected their all-in price for this reporting period, but I think if you kind of normalize that, that looks very compelling given where current spot prices are. They managed to, I guess, stem the bleeding. Production was down, but probably not as much as it could have been with that flooding. And you've still got that PGM dollar basket price moving higher. And so I think I'm generally on the bullish side of where those are going, and so Valterra fits nicely within that.
Staying with you for a moment, Devin, a couple of questions coming through around defensive stocks. The first one, Anheuser-Busch. I've been holding it for a while. I bought it as defensive. Not sure if it's as defensive as I thought or if it is worth continuing holding. Devin, your thoughts on Anheuser-Busch?
Yeah, I mean, that defensive label can be very dangerous because it's defensive till it isn't, right? But yeah, and Anheuser really been working hard at reducing that massive debt pile that they have been doing so, but the absolute levels I would argue are still probably on the high side. They're trying a few strategies that are starting to work. They're looking at premiumization in North America. That obviously comes with high margins. That's working quite well. And generally being pretty good at cost containment. They probably haven't seen the growth that they would want, the volume growth in some of their emerging markets. But yeah, overall, it's done okay. But I think, in terms of price action, probably been a more disappointing counter.
Cobus, Anheuser-Busch for you?
High quality, yes. There's some execution risk, and it is a bit of a hybrid. It's not often you'll see a defensive stock so highly rated. There's a lot of growth built into the price, and there is execution risk, specifically around the two major growth markets in Asia and Latin America. One of which China has been a tiny bit disappointing. But there's further adoption and further penetration still into both of those markets, and frankly, significant top line growth. Management team are infamously cost focused. It's a well-run business, and we continue to like it. There will be some volatility, but if you take the long view here, it's a high quality name, and frankly, at the current valuation, it's not that expensive.
The other one, Cobus, staying with you, British American Tobacco, different person, but saying defensive, but is it because of move to combustibles and the uncertainty around that? Stock has done very well for me. Maybe time to take some profit. Cobus, British American Tobacco, it certainly has. I mean, it's what, 900, in fact, close to 1,000 almost. British American Tobacco, still opportunity there.
Look, if I were to start a brand new share portfolio, the first stock I'd always buy, the bedrock is the stock. It's a sunset business. Focus on that for a second. The rating on those on the ex-combustibles is actually not as attractive or as high as it used to be. This is trading on a forward PE of less than 11. The yield is hard currency. It's very high. It is a sunset business, absolutely, but it absolutely prints money. The margins are incredibly high. It is very well managed, and the return on equity will continue to be very high until the day the last cigarette is smoked. On the other side, on the growth side, some of the risks around e-cigarettes and the like seem to be alleviating somewhat, because of the deregulation, the aggressive drive to deregulation we're seeing in the US market in particular, where they were facing the most severe of those regulatory risks. So I still think the valuation is undemanding, and it remains a high quality business that I like to hold.
Yeah, and as you say, quarterly dividends in sterling, nothing to knock around that. Devin, British American Tobacco?
Not as positive. I mean, I agree that the valuations have been pretty attractive and been pretty attractive for a while. Really strong yield coming out of the stock. I think they've done well into shifting the business model away from full reliance on combustibles. But yeah, there's a lot of risk in these business strategies, particularly regulatory risk, and with the new gen product. I think it's a fairly safe bet, but I'm not too sure that the growth going forward is necessarily worth it. But yeah, I guess a safe place to put your cash. So yeah, so summary, I'm fairly neutral on it, I guess.
Devin, we'll stay with you. A question came through around Netflix. I've done spectacularly well. The results look good. Do I hang on? I mean, I was actually chatting with Fifth Governor this morning, and he says they lack the leverage, perhaps, of a Disney with their, merchandising and the like. But make no mistake, I mean, Netflix is rocking. Although 50 PE, Devin, Netflix for you at this point, do you buy, sell, hold?
Yeah, look, I mean, I think if you're in there's a case to carry on holding. We're in an environment at the moment, particularly in the US equity market, where the strong just get stronger, and where they have this market leadership, they're just able to really press that home and further entrench themselves, further create market share dominance, and I'd put Netflix into that. So they've got a few good growth drivers that they're executing on. Their advert supported tier has been really really well subscribed to. The password sharing crackdown has been good for profitability, and them using AI to boost ad revenue. The expectations there are for that to really start to ramp that up quite a bit. So I like it. I think the valuation is it is 50, so take that in mind, and if they don't deliver, there is going to be disappointment, as we spoke about at the top of the show. But yeah, massive moat on a business like this, still spending a lot in content generation, and I think one to look at.
Yeah, and to be clear, 50 PE, but I think earnings per share was up 47, so not completely crazy. Strong gets stronger, and we see it. And I can remember having a debate with someone, maybe it was a decade or so ago, and it was the classic, pick and pay Checkers. And I'm like, but, Checkers, or ShopRite as it is the dominant one. They're the strong one. Never underestimate that sort of strength of momentum, not in share price, but in business operation.
Yes, that's exactly right. I mean, once you've entrenched yourself into a consumer's wallet, and there's an affinity to your products and services, and there's a frictionless way that they engage with buying with you or consuming whatever you sell, it's quite difficult to unseat that. And the incumbents definitely have an advantage. What it also means is if they are growing, they have increasing capital coming in that they can reinvest in the business and keep those existing clients engaged. So yeah, oftentimes it is a market share gain. The example you mentioned of ShopRite just doing that incredibly well against all other competitors. And catch up is very difficult and very expensive. So it gives them the ability and the capital to innovate while being ahead of the pack.
Cobus, the trick with, of course, the strong get stronger is that you often have to pay up for it, and that sometimes feels a little bit painful because you're buying quality, but you don't get it always cheap. And I'm thinking, Capitec, is not cheap, but man, they keep on going.
ShopRite, Capitec, Nvidia, these are absolutely so-called FOMO stocks. Where's the sell-off so I can finally buy? But the point is, all this capital is waiting to buy into these dominant players, and they are in spaces where the second best stock simply doesn't get anywhere near the rating. It's not quite winner take all, but there's certainly an element where the most dominant name seems to get the best rating and seems to continue to execute well. But I find it hard to add much value to a share that has 66 sell-side analysts worldwide covering it. Perhaps not. I don't have the depth here to do all of the research and take the view on the quality of the offering if this momentum will continue. But frankly, just given the broader market sentiment, I fully expect the share price to continue to perform reasonably well.
Yeah, and I like your point around don't fight 66 analysts. Question just come through on the emails. Motus and CMH, any impact from tariffs? Neither are exporters, so that's not an issue. Cobus, Motus, CMH, and I'm going to throw rebuy cars into it. They're a little bit different, but we've got a bit of a car sector on our JSC. Are any attractive to you at current levels and in the current environment? I always say, it's better being a consumer than it was a year ago in South Africa, but be clear, it's still tough.
Yeah, very tough. But the numbers, the consumer numbers, so call it not the light commercial and commercial has sort of ticked along. Other than, of course, the enormous disruption we saw in the taxi industry per se, which led to the introduction of WeBuy cars, frankly. But we have seen the NAAMSA numbers pick up. There is some uncertainty around the impact of the Chinese brands. However, these big names, the likes of Motors and CMH, are getting some proportionate representation within the Chinese brands, and that is expected to continue in terms of those partnerships. The valuations are very, very suppressed at the moment. So there's perhaps a little bit of a cyclical play here that does seem to be turning. And if we get further relief from the Reserve Bank later, later in the week, we'll hopefully, as is expected, we'll hopefully see a further uptick in that consumer confidence and a further uptick in what's really only now returned to pre-COVID levels in terms of light vehicles being purchased.
Yeah, and MPC Thursday, of course FOMC on Wednesday as well. We hopefully get more than a quarter, but I think a 0.25% is all we can truthfully expect. Devin, Motors, CMH, WeBuy cars?
Yeah, I mean, look, that used car market specifically, Simon, was really cumbersome and a poor customer experience, quite frankly. And I think, if I focus in on WeBuy cars, what they did with their tech platform is just to make it that much more slick, that much more frictionless. And as a result, really kind of brought down the margins for the industry, but they were able to ramp up the volumes and are now the largest used car dealer. So yeah, WeBuy cars, one that we like. I mean, I agree with Cobus in saying that probably the likes of a CMA and Motus have turned the corner. They've really come to a rough old patch at the moment. Consumer spend has just been, really under pressure. And so any help that we'll get from hopefully some economic growth or looser rates will benefit them. And the big Chinese manufacturer question there on who wins, who gets to distribute effectively. But there's no doubt those cars are here to stay. And it might reshape the landscape quite a bit.
Yeah, and to your point, Motors and CMH, I mean, they will get some of those dealerships in the space.
Yeah.
Devin, a nice easy question came through my Twitters earlier today. Do I carry on holding on to my gold miners because I have made eye-watering profit? I love the eye-watering profit part. Would you still be holding gold miners at this point?
Lovely, well done. I would say yes. I mean, I think the future remains uncertain. I think these trade wars and disputes, although feels a little quiet, we've got some deadlines coming up at the end of this month. There's the very real risk that those don't go well, particularly with bigger markets like China, Mexico, that type of thing. So watching that closely. And then the geopolitical risk is still there. So I think, put all that together, potentially unexpected inflation spikes, to me makes sense to hold some gold in the portfolio. Obviously, the gold miners, you get the gearing, and so you get the big ups and the big downs. But yeah, I wouldn't be in a rush to sell.
Cobus, would you be hanging on to your eye-watering gold miner gains?
Does it have to be binary?
No, it does not have to be binary.
Now's a good time probably to rebalance your portfolio.
Yeah.
If you have been concentrated gold miners, maybe sell some of those, buy the rest of your ex-gold miner portfolio. If the golds continue to outperform, you can sell some more later down the line. If the other stocks outperform, you can switch back into your gold stocks at a later stage. That's sort of the beauty of being invested for the long term and having a diversified portfolio. Just agreeing with Devin again, the environment remains accommodative to gold, and we remain slightly overweight gold, given that we actually dislike the resources stocks in general. I'm sort of at the point where I believe the only real catalyst that could shift that gold price is a real change in the monetary outlook. If we see inflation rear its head again in the US, that might be a bit of a catalyst for a sell-off from gold. But for the moment, inflation remains benign. And I actually like having, holding the more marginal producers that are going to continue to print money at this elevated gold price, rather than taking the longer view for the miners that have even the higher quality, more speculative assets, the likes of Goldfield. No, I'd much rather have Harmony.
Yeah, I got you. And a bit of rebalancing isn't a bad idea. Now, I'll let everyone know when I rebalance, because every time I do, they just head for the moon because I just sold a little bit. Cobus, let's stay with you. Aspen, simple question. Any hope?
There is no immediate catalyst for a recovery in Aspen. There's a lot of uncertainty around. Frankly, the management team has lost credibility once more, and they seem to have this habit of trying to produce a disappointment once every 5 years at least. But the fact that they didn't see this coming, and that we still don't know who the partner is that managed to exit, we can speculate on that. But having to replace the capacity and the French facility with hopefully some sort of weight loss or diabetic treatment. Again, this is all highly speculative, and frankly, they're sitting with a heck of a lot of overcapacity that they don't have customers for. So no, I think for the moment there's no immediate upside in Aspen, and even at this suppressed level, I don't really see anything, any positive short-term outcome.
Devin, Aspen. Certainly, there have been a bit of a serial sort of disappointer from management.
Yeah, look, I think Cobus's side, before he answered about Aspen, said it all. It's just been a massive investor disappointment, and really lost the confidence of the market. So yeah, not one we're rushing into for a long time.
Yeah, and it is every couple of years they come out and disappoint everyone. Yeah. Let's go to some stock picks. Devin, you're going with Invicta.
Yes, a small little industrial company in South Africa, specialized in consumables, auto, agri parts, capital equipment, that type of thing. They built up a really good portfolio of brands over the years, about 400 different brands there. What I like, though, is that they supply and service these industries. So they sell you the parts, they do the service and all of that. So that's very attractive. And they, as we've discussed before, they've been cleaning up the capital structure there, getting rid of the pref. So I think there could be a nice uplift in the near future there. And yeah, we think it's a well-run, solid little business.
Yeah, and that press, I think we said it before, that sort of adds 70 million a year straight to their bottom line, which they don't have to pay an interest. That is meaningful. Cobus City Lodge Hotels.
Here I am in 2025 calling a COVID recovery stock, but frankly, that's still what City Lodge is. One of those businesses that suffered severely through COVID had to go through a recapitalization process. And frankly, given that they had deferred the refurbishment of their hotels for so long, they continue to be a significant performance overhang in the business. Simple underutilization of capacity. And you can imagine if there's a lot of construction going on inside of the hotel and you're a business traveler, that is not an attractive prospect. And even if you are willing to deal with it, you'll deal with it at a discount. So I called the stock precisely a year ago. Once you add back the dividend, you've basically been flat. So I was frankly early, but I think given that the thesis has continued to play out, it is well managed, and given that the assets are now spanking brand new, and we expect that business travel growth to continue to tick up in South Africa, they are very directly exposed to that. Given the undemanding valuation, again, there is very, very easy upside from the current level.
Yeah, and the food and beverage is doing good, but I had a friend who stayed at a City Lodge and whilst there was construction, and he hated it, but they gave him a free night the next time he returns, and then it was spanking new. That's all for Stockwatch today. Thanks to our guests, Cobus Potgieter, Southern Cross Capital, going with City Lodge Hotels. Devin Shutte from the Robert Group, going with Invicta. Up next, The Close. Stay watching.